Every time the Federal Reserve bumps rates up by 1%, roughly $3 trillion in bond market value gets wiped out. Not crypto, not meme stocks, bonds. And here's the part almost nobody connects. You do not have to own a single bond for that to wreck your mortgage affordability, your stock returns, your retirement timeline, and the buying power of every dollar you have ever saved. The bond market is doing this to you right now. It has been doing it your entire investing life. And once you understand the actual mechanism, you will see every major financial decision you have ever made in a completely different way. This is not bonds are boring but important content. That framing is exactly why bonds get ignored in every conversation. The bond market is about $140 trillion. The U.S. stock market, the thing most people actually watch, is roughly $48 trillion. The bond market is nearly 3 times bigger than the stock market. It sets the price of money itself, and the average retail investor tracks it almost never. That is the real scandal here, not manipulation, not conspiracy. The scandal is that financial media spent 20 years making bonds sound dull, while the bond market quietly set your mortgage rate, shaped your 401k balance, and influenced whether your employer could afford your salary. It did all of this in public, with free data on government websites, while everyone stared at stock tickers and wondered why their financial plan kept falling just a little short. By the way, I built a free early retirement calculator, because most online ones are mathematically wrong. They use bond yield and equity return assumptions that are years out of date and make your retirement plan look better than it really is. Mine uses BlackRock and Vanguard's own methodology to reveal the specific weak points in your projection. I only ask for your email so I can send the report. Link is in the description. Now, one idea, one metaphor. Keep it in your head for this whole video. Think of the bond market as gravity, not a dial, not a background variable. Gravity. Stocks, real estate, crypto, your index funds. They all behave like they are flying freely, making their own choices, going wherever storylines and momentum take them on any given day. But every one of them is orbiting the bond market. When gravity shifts, when yields move, everything adjusts. Not instantly, not obviously at first, but always in the end. And the mistake that costs most investors the most money is not that they pick the wrong stocks or pay too much in fees. It is that they spend all their time studying the planets and never think about the force actually pulling them. Every time I look at my own portfolio, and I have several $100,000 invested, real money, not theory, the first question I ask before touching anything is, where is gravity right now? What are yields doing? That single question tells me more about the near-term outlook for stocks, real estate, and credit conditions than any earnings report or investment newsletter ever will. More than 10 years running my own business, surrounded by accountants and tax attorneys, taught me how money actually moves. And the lesson that kept showing up, the lesson people managing serious capital kept coming back to, was the same. Watch the bond market before you watch anything else. In a few minutes, I'm going to show you a signal inside the bond market that has predicted every U.S. recession since the 1960s. It is there for everyone, and it has been sitting on a free government website this whole time. But first, let me show you why most people understand bonds exactly backward, and what that backward understanding has quietly cost them for years. Here is the dominant mental model most investors carry. Bonds are the safe, boring asset you move money into when you get older and can no longer handle volatility. Stocks are for growth. Bonds are for preservation. Aggressive portfolio means fewer bonds. Conservative portfolio means more bonds. That is the framework. Neat, simple, and catastrophically incomplete. Because it treats bonds like an investment product when they are actually a pricing mechanism. Bonds do not just offer you a return. They set the price of every return in the financial system. They are the benchmark every form of risk-taking gets measured against. Every institutional investor on the planet, every pension fund, every endowment, every sovereign wealth fund, prices every asset they touch against the risk-free rate before they make any other decision. Bond yield is the floor. It is what you need to beat to justify taking any risk at all. And most retail investors have never framed it that way once in their lives. Let me tell you about Michael. Michael is 41. He has been investing since his late 20s. Never owned a bond. He thought bonds were his grandfather's asset. Low yield, low excitement. Something you held when you were too nervous to be in real investments. He owned a diversified portfolio. U.S. equity index funds, some international exposure, a REIT, solid, disciplined stuff. He knew his expense ratios. He rebalanced every year. In 2021, his portfolio gained 38%. He was feeling, as people say, pretty good about himself. Then 2022 showed up. In 2022, the Federal Reserve raised rates 11 times. The federal funds rate went from basically 0 to 4.5% by year-end. The most aggressive tightening cycle since the early 1980s. Michael's stocks fell 20%. His REIT fell 25%. His international holdings fell 19%. Everything moved in the same direction, at basically the same time, for what felt like no reason connected to anything specific he owned. Michael did what disciplined investors do. He went back to fundamentals. Revenue was still growing. Margins were under some pressure, but manageable. The companies he owned were still profitable. So why was everything dropping? Because gravity shifted. When the risk-free rate, the return you can collect by lending money to the U.S. government with basically zero default risk, goes from 0.1% to 4.5% inside one calendar year. The price of every other asset class in the financial system has to adjust. It is not psychology. It is arithmetic. Here is how the math works. When you buy a stock, you are making a bet that the company will generate returns that justify the risk you are taking. But those expected returns have to be compared against something. The baseline, the thing every investment competes against, is the risk-free rate. Right now, in early 2026, the 10-year U.S. Treasury yield is sitting around 4.4%. That means you can lend money to the U.S. government for 10 years and collect 4.4% annually, with, for all practical purposes, zero chance of default. So if you are going to buy stocks instead, which carry real risk of company failure, earnings disappointment, sector disruption, management mistakes, and incompetence, you need to believe you will earn meaningfully more than 4.4%. The gap between what you expect from stocks and what you can get risk-free has a name. It is called the equity risk premium. Historically, that premium has run around 3 to 5 percentage points above the risk-free rate, meaning stocks should deliver roughly 7 to 9% annually to justify their existence in a 4.5% yield world. Over long periods, the S&P 500 has averaged around 10%. Gravity is roughly balanced. Now run that same math for 2021. Bond yields were near zero. The 10-year Treasury was at 1.5%. In that world, even if stocks only returned 5% or 6%, the equity risk premium still looked attractive. Stocks could afford to be expensive, and they were. The price-to-earnings ratio on the S&P 500 reached 37 at its peak. By historical standards, extraordinary. But in a near-zero rate environment, almost rational, because the alternative was 1.5% on a 10-year bond. Then rates went to 4.5% in under 12 months. Suddenly, those same stocks, priced for a near-zero rate world, looked dramatically overvalued relative to the new risk-free return. The repricing was not a sentiment crash. It was the gravitational field resetting. Michael lost 20%, not because his companies got worse. He lost 20% because the bond market changed the rules, and nobody had told him to watch for it. A totally standard financial advisor, collecting a totally standard 1% annual fee on Michael's portfolio of around $300,000. That is $3,000 a year, by the way. Whether Michael made money or not had never once explained what the equity risk premium was. He never mentioned that stocks are constantly in competition with bonds for capital. He never said when the risk-free rate moves, everything gets repriced. The incentive structure of that relationship rewards keeping Michael invested, not keeping Michael informed. That is a mild disappointment, not outrage. The system works exactly the way it was built to work. By the way, hit subscribe if you are finding this useful, because the algorithm genuinely may never show you my videos again. And this is exactly the kind of content that does not appear on a financial planning firm's YouTube channel, where they are also managing your money for 1% a year. Now this is where it gets really interesting, because I promised you something. I told you there is a signal inside the bond market that has predicted every U.S. recession since the 1960s, and it has been sitting on the Treasury's website for free. Here it is. You think the problem with ignoring bonds is that you miss out on a fixed income product in your portfolio. But actually, the real problem is that you cannot see recessions coming, even when the bond market is broadcasting them in plain text, on public data, in real time. It is called the yield curve. The U.S. Treasury issues bonds at different maturities: 3 months, 2 years, 5 years, 10 years, 30 years. Each one has its own yield. Under normal conditions, longer-term bonds pay more than shorter-term ones. You want more compensation for locking your money up longer. 10-year bonds yield more than 2-year bonds. That is the normal shape, but sometimes the relationship flips. Short-term yields rise above long-term yields. The 2-year Treasury pays more than the 10-year Treasury. That sounds like a technical footnote. It is the most reliable recession predictor we have. When sophisticated institutional investors, the largest pension funds, sovereign wealth funds, and banks in the world expect economic deterioration, they park capital in long-term government bonds. High demand drives those prices up and yields down. Meanwhile, the Fed keeps short-term rates elevated to fight inflation. So short-term yields stay high, while long-term yields fall. The curve inverts. This is the bond market, the most information-dense, institutionally sophisticated market on Earth, collectively pricing in deterioration with actual capital. The yield curve inverted in March of 2022. Severe financial stress followed. It inverted before 2008. The financial crisis followed. Before 2001, recession followed. Before 1990, recession followed. Before 1981, recession followed. You had access to the signal every single time. Free, public, updated daily on treasury.gov. Oh, the yield curve? Yeah, we monitor that, said every financial planning firm while sending clients a quarterly newsletter about the importance of staying the course. Look, some of them genuinely believe the long-term, whole market framework makes the yield curve less relevant for the average 30-year investor. And for a 25-year-old with decades of runway, they might be right. But for someone with a specific retirement number, a specific timeline, and limited ability to absorb a 40% drawdown at the wrong moment, they deserve to know the signal exists. Staying the course is advice. It is not always analysis. Now I want to introduce someone. Keep this person in mind for the rest of the video. His name is Daniel. Daniel is 53 years old. He has $600,000 saved across his 401k and a taxable brokerage account. He has been a disciplined investor. His whole adult life he contributed consistently. Never panic sold, diversified reasonably well. He wants to retire at 62. That is a 9-year runway. His plan, built with his advisor, assumes 6% real annual returns on a 60-40 portfolio. At that rate, with continued monthly contributions, he should land around $1,200,000 at retirement. His advisor says, "You're on track." But here is the thing about Daniel's plan. I am going to come back to it. First, let me explain what the bond market is actually telling us about the environment right now, because it directly matters to Daniel and to anyone trying to build or preserve wealth in 2026. The U.S. national debt is about $37 trillion. The country runs a deficit, spending more than it takes in, of roughly $1.8 to $2 trillion per year. The debt-to-GDP ratio is around 122%. For context, conventional economic thinking suggests ratios above 90% start creating structural drag on growth because debt service crowds out productive investment. Here is what matters specifically for your portfolio. Roughly a third of that $37 trillion in debt is short-term and needs to be refinanced within the next few years, rolled into new bonds at whatever the current yield happens to be at that time. When rates were near zero, rolling over this debt was cheap. The interest cost was manageable. Now that rates are in the 4 to 4.5% range, the carrying cost of that same debt has become a structural problem. The Congressional Budget Office projected that by 2025, the U.S. government would spend more than $1 trillion annually on interest payments alone. More than the entire defense budget, more than Medicare, more than Medicaid, entirely on servicing past debt. Think about what that actually means in practical terms. The government has a fixed amount of revenue. A growing slice of that revenue now goes to paying interest on past borrowing. Instead of building anything with forward-looking economic value, roads, research, defense, healthcare, all of that now competes with the interest bill. And the interest bill keeps growing. So what happens when the government needs more money, but is already spending over $1 trillion a year on interest? It issues more bonds. More bond supply means upward pressure on yields to attract buyers. Higher yields mean more expensive borrowing for everyone. You, businesses, municipalities, banks. More expensive borrowing slows economic activity. Slower economic activity pressures corporate earnings. Pressured earnings pressure stock prices. The loop feeds itself. But the government can lower rates to fix this. Yes, the Federal Reserve can cut rates, but cutting rates aggressively, while the deficit is running at $2 trillion per year, risks reigniting inflation, which erodes the purchasing power of every dollar you have saved, and every dollar your bonds pay you. That is the other direction the trap closes from. The government has 4 options: raise taxes, cut spending, inflate the debt away, or issue more debt. Every single one of those options flows through the bond market, and every single one has consequences for your portfolio that you can see coming if you know where to look. So what do I do? Sell everything and hide in cash? No, that is not the lesson. The lesson is, stop treating the bond market like someone else's problem. Where is gravity right now? 4.4% on the 10-year. That is the answer. Every other decision in your portfolio should be downstream of that number. Let me get specific. Here is the mini case study. You are 45 years old. You have $250,000 in your 401k. You are contributing $800 per month. You plan to retire at 65. 20-year runway. In 2021, when the 10-year Treasury was at 1.5%, the expected return on a classic 60-40 portfolio was genuinely around 7 to 8% annually. Run your $250,000 plus $800 a month for 20 years at 7.5%. You land at approximately $1,400,000. A strong outcome. Now update the environment to early 2026. The 10-year Treasury at 4.4%. In this environment, the bond portion of your portfolio earns more. In absolute terms, you are getting a real return on fixed income for the first time in 15 years. But your equity allocation faces compression pressure from that elevated discount rate. Valuations on U.S. equities remain historically elevated and need actual earnings growth, not multiple expansion, not narrative, to deliver real returns. A realistic expected annual return on that same 60-40 portfolio in the current environment is closer to 5 to 5.5%. Run the same scenario at 5.5%. $250,000 plus $800 a month for 20 years. You land at approximately $1,030,000, still over $1 million. Still a workable outcome. But the gap between those two scenarios is $370,000. At a 4% annual withdrawal rate, that gap is $14,800 per year less to live on, every year for the rest of your retirement. Every year. That gap was not created by bad stock picks. It was not created by high expense ratios. It was created by using a return assumption calibrated to a gravitational environment that no longer exists. The bond market changed. The projections did not update. And you will not find out until you are 65, and the spreadsheet does not match the account balance. But here is the term, and this is the part most people miss completely. That same yield environment that compressed your long-term expected equity returns is also offering you something you have not had access to since 2007, a genuinely attractive risk-free return. Short-term Treasury bills in early 2026 yield approximately 4.2 to 4.5%. No duration risk, no credit risk, no volatility. And the interest on Treasury securities is exempt from state and local income taxes, which for someone in California or New York meaningfully improves the after-tax yield relative to a corporate bond or a big bank savings account. If you have any cash sitting in a standard savings account right now, you should know that major retail banks are currently paying somewhere between 0.4 and 0.5% on savings deposits, while they invest those deposits in instruments earning them considerably more. The spread between what they collect and what they pay you is, charitably, the business model. Uncharitably, it is a transfer of your money to their shareholders that relies entirely on your inertia. On $100,000 in a lazy savings account, earning 0.5% instead of 4.5%, you are leaving $4,000 a year on the table. Compounded over 9 years, the difference between a lazy cash position and a Treasury ladder is over $40,000. On $100,000 you already have sitting somewhere doing almost nothing. Gravity works in both directions. When yields are high, the bond market is also offering you compensation for patience and capital preservation that you have not seen in more than 15 years. The exact same mechanism that pressured equity returns in 2022 is now offering you a legitimate, risk-adjusted return on cash you are holding in reserve. The people who understood the bond market saw this in 2022. They moved idle cash from near-zero savings accounts to 4.5% treasuries, while everyone else watched the stock market fall and argued about when to buy back in. But I looked at Treasury Direct once, and the interface looked like it was designed in 2003. Fair. Use a brokerage instead. Buy T-bills through Fidelity or Schwab the same way you would buy a stock. 3 clicks. This is not an obstacle. Now let me close out Daniel's story, because Daniel's story has a better ending than you might expect. Daniel found out about the yield curve in early 2022, Not from his advisor, from a YouTube video at 11 p.m. on a Tuesday, which is genuinely how most real financial education happens in this country. He had watched his portfolio drop and could not reconcile it. His companies looked fine. The fundamentals had not deteriorated. Why was everything falling? He looked it up. He found the yield curve chart. He saw the 2-year Treasury rise above the 10-year in March of 2022. He understood for the first time that the bond market was telling him something his equity analysis could not show. He shifted 15% of his equity exposure, about $90,000 at the time, into 6-month T-bills, yielding 4.3%. He did not sell everything. He did not panic and exit the market. He made one measured, informed adjustment based on what gravity was broadcasting. His portfolio still fell in 2022. Nobody got through that year cleanly, but the 15% he had moved to T-bills earned 4.3% instead of losing 20%. The difference on $90,000 was about $21,000 saved from the drawdown plus the interest earned. In mid-2023, as the market started recovering, Daniel rolled those T-bills back into equities at prices roughly 15% below where he had sold. He did not time the bottom perfectly. He did not need to. He used publicly available information, made one better decision than he would have made without it, and positioned himself to buy cheaper on the other side. Over his 9-year runway to retirement, that single decision is worth, conservatively, accounting for compounding from a higher base, somewhere between $40,000 and $65,000 in final portfolio value. One number, checked once a week, informed one decision: $65,000. That is where gravity meets leverage. Let me give you the framework. 3 levels of bond market literacy that matter for a regular investor, not a bond trader, a regular person with a diversified portfolio who wants to stop being surprised. Level 1. Track the 10-year Treasury yield. That is the number. Check it the way you check the S&P. Right now, in early 2026, it is around 4.4%. Above 4% means growth assets face real competition from the risk-free alternative. Equity valuations are under constant pressure in this environment. If it starts climbing toward 5% or 6%, financial conditions are tightening meaningfully, and something usually breaks. If it drops fast toward 2% or 3%, smart money is scared and parking in safety. That is typically the early sign of a flight to quality, before stress becomes visible in equities. Level 2. The spread between the 2-year and 10-year Treasury yields. This is the yield curve. If the 2-year is above the 10-year, inverted, it is not time to panic, but it is time to be methodical. Reduce leverage. Hold a little more cash than usual. Consider whether your near-term allocation is calibrated for a stress scenario. History gives you roughly 6 to 18 months before conditions deteriorate meaningfully after an inversion. You do not have to move fast. You have to move deliberately. Level 3. Credit spreads. Specifically, the high-yield spread. The premium lower-rated corporate bonds pay above treasuries. When that spread widens dramatically. When companies with lower credit ratings suddenly have to pay much more relative to the government, the bond market is pricing in rising default risk. Credit spreads blow out before stock markets fully reprice. It is a leading indicator that shows up in fixed income before it shows up in equity prices. Watch it. Those 3 numbers. That is the instrument panel. 10-year yield. 2 to 10 spread. Credit spread. If you spend 5 minutes with those numbers once a week, you will understand more about where the macro environment is heading than 90% of retail investors who spend their time analyzing individual company earnings reports. The stock market is a current conditions indicator. The bond market is a forward-looking one. If you want to know what investors expect to happen in the next 12 to 18 months, you watch bonds. Ask yourself one question before you make any major financial decision. Where is gravity right now? Then, act accordingly. Here is the closing argument. Financial media gave you stocks because stocks have stories. Tesla goes up, Tesla goes down. There is a character. There is narrative. There is drama. Bonds do not have characters. They have yields, and yields do not make good television. But yields run the world. Your mortgage rate is priced off the 10-year Treasury. Your business loan is priced relative to the risk-free rate. Your employer's cost of capital is determined by credit spreads. The pension your parents rely on is wrestling with duration risk you have never even thought about. The U.S. government's fiscal capacity to invest in the next decade is being eaten up by interest payments flowing through bond auctions you could watch in real time if you knew where to look. None of this requires you to become a bond investor. None of the three things I'm about to tell you require you to buy a single Treasury note. 1. Go to treasury.gov, find the daily Treasury yield curve rates page, and bookmark it. Look at the 2-year and 10-year yields right now. Calculate the spread. Write it down. Check it again next month. This takes 4 minutes. It gives you access to the same signal institutional investors spend billions of dollars trying to act on faster than everyone else. You get it for free and in public. 2. Find out what return assumption is built into your current retirement projection. Your 401k. Your advisor's model. Your target date fund's glide path. If that return assumption is above 6.5% to 7%, ask whoever built the projection what bond yield environment it assumes. If the answer is vague, or if they assumed low rates, your plan may be meaningfully too optimistic for the current environment. Finding that out now, while you still have time to adjust contributions or expectations, is categorically better than finding it out at 63. Move your idle cash off the big bank savings rate. Right now, in early 2026, short-term treasuries yield 4 to 4.5% with no credit risk and meaningful tax advantages at the state level. The gap between a standard savings account and a treasury ladder is currently substantial. On $50,000 in cash, you are potentially leaving $2,000 a year on the table every year for nothing. That is not a rounding error. That is money you are paying the bank to hold your money while they deploy it for their own return. The bond market has been setting the price of your financial life for years. Every mortgage payment, every stock swing, every inflation-adjusted retirement projection, every credit card interest rate. It was all determined in a market you were told was too boring to understand. Now you understand it. Lazy investing built more fortunes than crypto memes. And the single laziest, highest leverage move you can make this week is to spend 10 minutes checking 3 numbers on a government website before you touch anything else in your portfolio. Gravity exists whether you measure it or not. The only question is whether you are using the instrument panel or flying blind and calling it confidence.